Investment accounting valuation techniques in today's complex financial landscape. Investment accounting has evolved from simple record keeping into a critical discipline that ensures transparency and accuracy across diverse asset classes. This comprehensive guide delves into advanced valuation techniques, compliance frameworks, and strategic considerations essential for modern accountants managing corporate investments. The evolution of investment accounting standards. The history of investment accounting dates back to early 20th century when businesses began investing in other entities through stock purchases and debt instruments. Rapid expansion of global markets in the post-World War II era. Each paragraph should be concise, focusing on one idea, using bold or italic for emphasis. Lists should highlight key points. The conclusion needs to summarize the key takeaways and encourage continuous learning and adaptation. I also need to ensure that the HTML syntax is correct, proper opening and closing tags, nested elements correctly placed. No markdown, just plain HTML. Checking for any typos or structural issues. Finally, verifying that the total length meets the 2,000 to 3,000 word range. Given that each paragraph is brief and there are multiple sections, the overall content should fall within the desired length. Investment accounting valuation techniques in today's complex financial landscape. Investment accounting has evolved from simple record keeping into a critical discipline that ensures transparency and accuracy across diverse asset classes. This comprehensive guide delves into advanced valuation techniques, compliance frameworks, and strategic considerations essential for modern accountants managing corporate investments. The evolution of investment accounting standards. The history of investment accounting dates back to early 20th century when businesses began investing in other entities through stock purchases and debt instruments. Rapid expansion of global markets in the post-World War II era created an urgent need for standardized reporting practices to prevent misrepresentation of investment values. FASB introduced ASC 326 in 2016, which completely overhauled previous guidance under SFAS 115 by establishing the current expected credit loss (CECL) model for impairment assessments. GAAP requirements now mandate quarterly evaluation of market risks affecting equity and fixed income securities held for trading purposes. Credit risk adjustments. Entities must proactively assess counterparty default probabilities when valuing derivatives and structured products. Liquidity premium calculations. Market illiquidity factors are now explicitly considered in fair value measurements for private company equity positions. Interest rate sensitivity analysis. Required for all long-term bond portfolios subject to yield curve fluctuations exceeding plus or minus 100 basis points. The transition to the CECL model significantly increased documentation requirements as companies had to establish historical loss data benchmarks for various economic cycles. Fair value measurement frameworks. Fair value measurement standards categorize assets into three distinct levels based on observable inputs available in active markets. Level 1 assets include traded equities and exchange-listed bonds where quoted prices provide the most accurate valuation metrics. Level 2 encompasses non-traded assets valued using proxy models derived from similar actively traded securities. Level 3 requires significant unobservable inputs such as internally developed discount rates and future cash flow projections. Hierarchical classification. Proper categorization determines audit readiness and regulatory scrutiny intensity. Input validation. Auditors demand rigorous verification processes for Level 3 assets due to higher estimation uncertainty. Disclosure mandates. Companies must disclose quantitative information about fair value changes impacting net income statements. Recent SEC regulations require enhanced disclosure around valuation methodologies used for Level 3 assets above $50 million in aggregate value. Equity method investments. The equity method is applied when an investor holds between 20% and 50% ownership stake in another entity without control. Under this approach, investees' revenues and expenses directly impact the investor's balance sheet through equity account adjustments. Amortization of excess depreciation is required when acquisition cost exceeds book value of identifiable net assets acquired. Differential amortization affects both the carrying amount of the investment and reported earnings recognition timelines. Earnings recognition timing. Investors report their share of investee profits in the period they are recorded by the subsidiary dividend treatment. Cash dividends received reduce the investment account rather than being recognized as revenue. Goodwill testing. Annual impairment tests are necessary even though goodwill isn't separately identified in equity method applications. New EITF guidelines now require separate disclosures for consolidation adjustments made during intercompany transactions. Bond investment accounting. Treasury and corporate bonds require careful classification based on intent and ability to hold until maturity. Hold-to-maturity classification allows use of amortized cost model, while available for sale uses fair value adjustments with unrealized gains/losses affecting OCI. Effective interest method remains standard for calculating periodic interest income regardless of classification category. Early redemption provisions necessitate reassessment of remaining life and potential reclassification of securities. Yield curve positioning. Interest rate movements can trigger reclassifications between HTM and AFS categories. Premium/discount accretion. Amortization schedules must be consistently applied across different bond types. Covenant monitoring. Credit rating downgrades may force revaluation under new classification rules. Recent FASB updates expanded definitions of available for sale to include certain municipal obligations previously excluded from scope. Derivative instruments accounting. Complex derivative contracts require precise hedge effectiveness testing to qualify for cash flow hedging treatments. Time value components must be separated from intrinsic value when measuring effective portion of hedges. Designated hedges must demonstrate high correlation with forecasted transactions at inception date and subsequent modifications. Metric volatility thresholds have been tightened to ensure hedge relationships remain economically meaningful. Hedge ratio constraints must not exceed 120% of anticipated transaction volume to maintain hedge effectiveness. Reassessments frequency. Quarterly evaluations required for all material hedging relationships. Documentation rigor. Comprehensive records needed for all hedging decisions, including rationale and risk management strategies. New ASU 2022-2009 introduced stricter criteria for applying hedge accounting to foreign currency risk exposures. Private equity and venture capital accounting. Valuation of private equity interests presents unique challenges due to lack of public market pricing references. Discounted cash flow models dominate but require extensive assumptions about growth trajectories and exit multiples. Appraisal premiums reflect control benefits that are typically absent in publicly traded shares. Real estate investment trusts demand special consideration regarding capital stack structure and leverage ratios. Sensitivity analyses required for all key input variables in DCF models used for private equity valuations. Capital call tracking. Detailed reconciliation process is necessary for venture capital fund subscriptions. Leverage impact. Debt service requirements must be incorporated into projected free cash flows. SEC recently issued guidance emphasizing the importance of disclosing valuation methodology limitations for alternative investment holdings. Regulatory compliance and disclosure requirements. Publicly traded companies face stringent disclosure mandates regarding investment portfolio composition and performance. GAAP requires segmentation of investments by type, industry sector, and geographic region in annual filings. SEC Form 10-Q mandates quarterly disclosure of realized and unrealized gains/losses exceeding specified thresholds. XBRL tagging standards facilitate automated data extraction for regulators and investors alike. Materiality thresholds vary by security type with greater emphasis on fixed income compared to common stock. Forward-looking disclosures required for structured notes containing embedded derivatives with uncertain outcomes. Audit trails. All valuation methods must be documented with supporting evidence for at least 5 years. New proposed rule changes would expand disclosure requirements for cryptocurrency-related investments held by regulated institutions. Technology integration in investment accounting. Modern accounting systems integrate real-time price feeds and algorithmic valuation engines for instant portfolio assessments. Machine learning capabilities enable predictive analytics for identifying emerging market risks within investment portfolios. Blockchain technology facilitates transparent tracking of complex derivatives positions across multiple counterparties. Cloud-based solutions allow seamless collaboration among geographically dispersed investment teams. Data integration, critical for maintaining consistency across general ledger, tax reporting, and regulatory submissions. Automated reconciliations reduce manual errors in daily mark-to-market processes. AI forecasting enhances decision-making through scenario modeling and stress testing capabilities. Leading firms are implementing robotic process automation to handle routine tasks like dividend processing and coupon accruals. Professional development for modern accountants. Ongoing education is vital given the continuous evolution of accounting standards related to investment vehicles. CPAs specializing in investment accounting must stay updated on SEC rule changes and CABE pronouncements. Certification programs offer specialized tracks focusing on alternatives, fintech innovations, and digital currencies. Industry conferences provide networking opportunities with leading experts in portfolio valuation techniques. Continuing education credits, required for maintaining CPA licensure and staying compliant with state regulations. Simulation exercises help practitioners understand application of new standards in realistic scenarios. Peer review mechanisms encourage knowledge sharing and quality assurance within professional networks. E-learning platforms now offer interactive modules covering complex topics like convertible instrument accounting and securitization structures. Emerging trends in